we talked a couple weeks ago. You talked about a 4.4% peak funds rate. Are you still in line with that idea?
I think I said 375 to 4 is my target for this year, for the end of this year. And I like the front loading. I like the idea that you get the rate increases in earlier rather than later. We've got inflation right now. We've got a strong labor market right now. It seems like a good time to get to the right neighborhood for the funds rate.
We had a good debate in the noon hour about the idea of 50 or 75 and how much it matters. Why does it matter to go faster? What's the upside of that?
Yeah, I think the front-loading idea is that first of all, you show you're serious about inflation fighting, and you want to get up to the level that will put downward pressure on inflation. And we're at 233 right now. You know, that's not high enough to be serious about putting downward pressure on inflation. Market has helped us a lot. There's been a lot of pre-pricing during the spring and the summer here. But we have to get our policy rate to where it needs to be to put downward pressure on inflation. And I think you got to have a 3 handle.
What happens after 375 to 4 at the end of this year?
Yeah, I haven't talked much about next year, and I think...
Feel free.
Yeah, well, this is such a volatile environment that you're not quite sure what's next. And so I think I'd want to be careful about promising anything one way or another about what would happen next year. But, you know, a baseline would be that probably inflation will be more persistent than what many on Wall Street expect, and that's going to be higher for longer, and I think that's a risk that's underpriced in markets today. Yeah,
so do you worry about that when you look at the outlying futures contracts and say they're not embracing the rate hikes that I think, or the kind of financial conditions that I think need to be there?
They're showing outstanding confidence in the Federal Reserve, which I appreciate, and I really hope that they're right. If we act early and aggressively, that we will bring inflation under control relatively quickly. But the risk is that the other side of that isn't being priced enough, and you know, the reality is we may have to be higher for longer.
Talk to me about how you react. And I understand you try not to react to the day-to-day changes, but in general, when you see the stock market rising, you see bond yields falling, does it make you feel like you have other work to do?
You know, I try to stay kind of away from equity pricing because there's so many things going on in equity markets, sure, and a few stocks can drive the market on a given day. And usually those are developments at those particular firms. And you've got the heavy Silicon Valley component, and who knows how to value those companies. So I don't want to take too much signal from equities when I'm trying to make monetary policy. I try to look at other aspects of asset pricing, you know, spreads, volatility, levels of rates.
But right now,
real rates.
Bond markets yields are higher. Does that give you more comfort that your message is getting out of what it is you want the market to embrace about financial conditions and where they're going?
I would say that that's a little better pricing of the risk that we'll have to do more at the Fed to keep inflation under control.
You talked earlier about this idea of inflation being more permanent. The topic of the conference here is constraints on the economy. There's some discussion and talk about the idea that maybe some of the factors that have led to high inflation now may stick around. Is there a world that's coming in, or an economy coming to the U.S. of higher permanent inflation?
I don't see any reason why we have to have that. I mean, you need to understand the economy in order to make monetary policy. And I would say if there are structural issues or things that are changing, that's very relevant for making monetary policy. But really, in the end, we have an inflation target because it's up to the central bank to hit the inflation target. And, you know, you take all those factors on board, you print the right amount of money for that situation, right, you should be able to hit the inflation target even if there are these long-run structural factors. I mean, it's important to understand those factors, but that doesn't stop us from hitting the 2% inflation target.